It's been fun listening to the conversation the rest of the day, as environmental markets have come up in almost every session I've sat in. So we've heard conversations about the Clean Air Act and how the NOx and SOx rules in the market there had significant success. We've heard discussions about, or I haven't been in every session, about investment in sustainable fisheries and rights-based systems, similar to cap share systems in the U.S. And then we've heard a lot about potential for cap and trade and carbon markets. So hearing a lot about environmental markets throughout the day. And so we'll dive into some of those in our panel discussion today and talk a little bit. I think there's different kinds of markets, and we're going to touch on some of them, but not all of them. But some of them really about the efficiency of the way we use our resources. And Mike's going to talk a little bit about water supply and how to do that more efficiently using some market-based mechanisms. We also have payment for ecosystem services types of programs, and Jim's going to talk a little bit more about some of those. And then we also have some of our regulatory-based markets, which overlap with those, that George is going to talk to us about some of those. And so I'm going to just briefly here introduce our panelists and their background and what they're going to talk about today. So we're going to start with Jim Sullivan, who sadly recently left his position at the Duke Law School. But he's still going strong. He's become the Donald Bren Distinguished Professor of Environmental Law with a joint appointment at UCLA School of Law. And he was one of the first to explore the legal and institutional issues in creating markets for ecosystem services, and has recently been exploring what's been accomplished, particularly for payment for ecosystem services programs. And he's going to give us an overview, kind of where that's gone over the last decade or so and where we are today. And then we're going to hear from George Kelly, who's the Chief Markets Officer at Resource Environmental Solutions. And before merging with RES, he was the founder and director of Environmental Bank and Exchange, where he permitted and sold over 90 million of environmental credits in the United States relating to wetlands, streams, endangered species, and water quality, so really spanning the regulatory markets here in the U.S. And he's going to tell us what he sees on the horizon for these markets, touching on opportunities and challenges ahead. And then we're going to move on to Mike Young. He's a professor at the University of Adelaide in Australia, where he holds a research chair in water and environmental policy, and is the founding executive director of its Environment Institute, and a fellow of the Academy of Social Sciences in Australia. And Mike has led teams that have developed frameworks for the introduction of greenhouse gas emissions trading systems in Australia, as well as fisheries management in New South Wales. But he's best known for his contribution to market-based instruments for managing water, and recently has been working with us in the U.S. West to try to explore those opportunities. So I'm going to turn it over to Jim to get us started.
Thanks, Lydia. So it's a real treat to be here. I joined the faculty, as Lydia said. I joined the faculty here in 2004. I just moved west this summer, and one of the main reasons I joined the faculty was I wanted to be on the ground floor when the Nicholas Institute was created. It's pretty cool to have the opportunity to be part of a new think tank, new policy, and it's grown by leaps and bounds. So it's great to be here to celebrate the. I was trying to think of what's the 10th anniversary. It's not like zinc. I mean, what is it? Celluloid, right? Anyway, so I was going to say something clever, but anyway, you know what I would have said. So all right, so where's the clicker? There we go. Okay, so this is a real cover from The Economist, kind of the paper fact for the capitalist world. And it came out in 2004. I still don't know exactly how they got the dollar sign on the Amazon. But the point of this was to say that basically this notion of payments for ecosystem services really had gone mainstream. When The Economist basically has this as the cover photo. I've been working on PES, that's the acronym we use, since 1997. And the growth of interest in PES has been nothing short of extraordinary. When I started working on it, late 1990s, early 2000s, really no one much was talking about it. And The Economist talks about it in 2004. And I really felt for a long time, a lot of folks in the field felt this way, that just the world was going to turn to PES. There's a huge amount of optimism about carbon markets, about other markets. And in fact, there was a group called Forest Trends. They put together a publication called Ecosystem Marketplaces on the Web that basically looks at market trends and payments for ecosystem services. They had a project they called The Matrix in 2006 and they basically plotted out, or got the experts around the world to make projections for where PES would be 5-10 years out. And if you look out 5-10 years later, they were correct in some areas, but in a lot of areas, actually, the growth really hasn't occurred really to the extent at all that people had anticipated. That said, there's still a lot of interest in payments-free ecosystem services. The Catskill story, which is essentially how New York City invested in green bonds for a watershed and set up in a new treatment plant. People have heard a lot about that as well. But the fact is, if you really look at what's going on there, there's a danger sometimes that so-called anecdata has been more important than actually real data. And so, as Lydia mentioned, I've been working in this field for a long time, and I've been increasingly concerned that to a certain extent the hype might be outpacing the reality. And so a year ago, with the folks right here, Jen Bennett, Nathan Carey, Goldstein, and Michael Jenkins, they all work at Forest Trends, which is the leading NGO in this field. We decided that we were going to actually take a very close look at what was going on in the field to try to get some kind of empirical view of what's going on. One of the dangers is that when you talk about payments-free ecosystem services, there's a real risk that it masks more than it reveals. And the reason for that is that PES is actually an umbrella term. Turns out PES covers a whole range of different types of payment mechanisms. And just very briefly, the notion behind PES is that you're paying someone to manage their land in a particular way, either to ensure provision of ecosystem services such as flood control, water purity, carbon sequestration, or you're paying them to change their land management to provide this stream of services. Another way to put it is you're trying to get folks to invest in green infrastructure instead of gray infrastructure. That's the basic idea behind this. As you can see, it covers a lot of different sectors, a lot of different transaction types, and also a lot of different payment types. So essentially what we did in this project was to ask ourselves what's really going on here, right? So these were sort of the three big questions we were asking in our research. Let's get empirical, and instead of talking about the great potential that PES has, let's actually look at what's happened and what we can measure. Which sectors have grown, which haven't, why, and then where are they going? I'm going to talk a bit about that. I think George is going to focus more on that issue. So I'm only going to take about 4 or 5 minutes because I want to keep this short so we can more of a discussion. I'm going to give you the highlights of what we found in this sort of year-long research project. Let me start with water. Water payments-free ecosystem services completely dominate the PES world. So depending on how you measure it, total PES payments last year, or actually over a 5-year period, were around $13 billion. 12 of those were water payments-free ecosystem services. Within that sector, China dominates. So of the roughly $12 billion that were dedicated to water payments-free ecosystem services, China accounts for 11 billion of that. And China really has adopted PES as a major policy instrument for how it's going to achieve land use measures to address erosion, deforestation, those types of issues. Another highlight, Latin America, water PES is booming through something called water funds. There have been 35 of these in the last decade. They all take the basic approach, basically the same approach, but they have very different structures that sort of operate throughout the different regions. I can talk about that a bit later. Last thing to talk about, which I think is interesting in water, is that there are requirements for what are called in-stream flows, keeping water in the rivers, in the lakes, for the fish, in the marine ecosystem. You find those in many nations around the world. They're only in operation in 2 countries. Right, so they're black letter law all over the place. They're in operation in the U.S. and in Australia. Right, so this is one of the things we find with some payments-free ecosystem services is that the legal authorities there, but you don't actually see them happening in practice. So that, at least to me, was a bit surprising. If you turn to habitat, similar type of finding in the sense that you've got a lot of discussion of payments for biodiversity around the globe. The only large programs exist in the U.S., Australia, and New Zealand. There's 0, depending on how you feel about ecotourism, in Africa. The EU basically is backed off from mandatory biodiversity habitat. It doesn't look like it's necessarily going to happen there. Voluntary payments for biodiversity habitat have remained fairly small. You can talk about land trust movements, and whether that's actually biodiversity or not, but leaving that aside, in terms of government payments, that's been small. The most interesting development in habitat has been this notion of access to capital. So the International Finance Corporation came up with something they call Performance Standard 6, and essentially says that if there's a project that requires more than $10 million in financing, they have to ensure there's no net loss. It's a mitigation approach. That's been adopted by the European Bank for Reconstruction and Development. It's been adopted in the Equator Principles, which has been accepted by 80 of the major banks. This is all happening right now. And so in a sense, it's got tremendous potential. We'll see what happens in the implementation. That obviously is going to be the key issue. But there's an important geopolitical aspect of this as well. China has been moving much, much more into international development aid. They don't require the same conditionalities. And so there's a very real question out there for these countries that want development aid. Are they going to turn to the IFC and EBRD and these other places, or are they going to turn to Chinese capital? That remains to be seen as well. Carbon, the highlight here is that payments for ecosystem services for carbon, at least to me, remain surprisingly small. The vast majority of the payments have not been forest or landscape-based in terms of markets. There's a lot of money that's flowing to what's called red preparedness, and that's been Norway and some other countries, and that's been a lot of money. And so the issue here, I think, is very much going to be what happens in Paris and beyond. And Brian Murray back there is one of the great experts on this. And we'll see if RED, which is basically payments to maintain forest cover, if that takes off, then a lot of money could flow in. But right now, what happens is the programs that actually these so-called market programs, they accept a very small percentage of sort of sequestered carbon. There's a cap in California, for example, of 8%. That's all you can put into the program. The last sort of highlight that I'll mention here, which is where I think there could be a lot of action, is essentially commitments from companies for commodities. So it turns out that companies with a market capitalization of $4 trillion, that's trillion with a TR, the P is silent, they have, I just had to throw that out there. The companies with a market capitalization of $4 trillion have made sustainability commitments for the commodities they produce. That's very exciting. The problem, of course, is that there's enormous variation in what they actually say they're going to do. There's no harmonization here. The other issue, obviously, is credibility and legitimacy. And the challenge here, you've got these, it's only a small number of commodities you're talking about, and you've got the Forest Stewardship Council, these roundtables. The problem is these groups have an inherent conflict of interest. Right? They want their certification to be adopted by producers, so there's an inherent conflict. They don't want to be too tough, because if they're too tough, people may not pick up their certification. And so whether there's going to be some kind of neutral third party or not remains to be seen. But credibility and legitimacy are the key issues here. So where does this leave us? This leaves us, I think, with two sort of main, at least for me, with two sort of main insights. The first is there's no question that PES is still rising and is still becoming, I think, a more and more important instrument in the environmental world, but it's extremely heterogeneous. Right? Biodiversity really has not played out the way people thought it would, at least outside the U.S. Water is just taking off everywhere. Carbon remains to be seen what happens with RED. That's sort of on the growth side, and the geographic spread side, and the value side. There's another question, though, which is that a good thing or a bad thing? And there, unfortunately, we don't really know. And the reason for that is there's remarkably little research on how effective PES actually is. Right? So how cost effective is it? How effective is it in terms of actually helping the environment? Does it actually help rural poverty? And the answer is, if you actually look at a whole range of projects, we don't know. Right? The effectiveness research has been really small, a small number of projects. All right, so I promised Lydia I would keep it under 10 minutes, which I have. So I will stop right here. Thanks.
So George?
Happy birthday, and great to be here, and I'm giving the practitioner's viewpoint, and I'm looking out into the future. One of the things I'll say, there's two things that I'll lay out right up front. One is, you don't have a market unless you have in the U.S., primarily we've seen this, unless you have a regulatory driver. You have to have the science to back the regulation has to drive the permit dynamics, and then no one has bought a single credit of mine unless they've had a gun to their head. Never. No one's ever voluntarily bought a credit. And I think that's the theme that I have in terms of a market. The other thing is, dollars doesn't mean something good in the ground. And too often we say pay dollars to some state entity or an in lieu fee program, and ultimately we see those either going to other forms of government or not ultimately to the intents and purposes that we laid out. So briefly, I'm not trying to advertise resource environmental solutions, but I wanted to give you a context of the world that I'm living in. I basically was the founder of a group called Environmental Bank and Exchange. We started in 1997. We got acquired in December of 2014 and merged with Resource Environmental Solutions in 2014. And I think that merger is an example in and of itself of where we think the market's going to go. Two large enterprises in the offset world that basically is pretty bullish on the opportunities. And why are we bullish? We're bullish because there's so many environmental issues, and we think this is a tool that can help. It's not the answer. And this is one of the things I'll say to you also is a lot of people want to criticize markets, but they want to put all the baggage. Should we be solving world poverty by virtue of doing a market approach to creating wetland mitigation? And that's the question that you have often in this instance. RES we're in 9 offices, and from the Gulf to the Mid-Atlantic, Southeast Appalachian. One of the things I really want to point out is we have 110 mitigation sites that we're involved with, but of that we've got 425 conservation easements. And I think this is one of the big points I want to raise as it relates to markets per se. You may quibble on the science, but at the end of the day, we are preserving 425 sites in a private capital dynamic that would not otherwise be preserved. And that is a huge issue. So in the course of this, we're involved with wetland mitigation. We've done about 32,000 acres of wetland restoration. We have customized mitigation solutions. There's this increasing sustainability initiative. Jim mentioned this concept of no net loss. What we're seeing is companies are now embracing sustainability initiatives short of regulation, so they're doing it themselves. We've done 155 miles of stream mitigation. We've reduced and sold over 240 tons of nitrogen. We planted over 8 million trees, and we've also done about 4,000 acres of endangered species. One other point in this slide is this study done on the restoration economy. Markets are part of this economy. There was a study done by Todd Bendor at UNC that recently came out that basically concluded that the restoration economy is a $25 billion industry per year, produces 221,000 jobs, both indirect and direct. And that is just below the automotive industry. It's ahead of coal mining. It's ahead of logging. And this is the point when we say, is there a dichotomy between the environment and business? There's a tremendous economic proposition behind what we do. Next slide. Briefly, I wanted to go over my view of environmental markets. And Jim defined, the broad umbrella of PES, Payment for Ecological Services. I define it a little differently, and I want to just walk through it so you guys understand my world. We have the resource mitigation or offset world. That's the idea of your new impactors basically have to mitigate for that impact to that resource. Typically, wetlands is a good example of that. And that again is focused on new impacts. Then you have the cap and trade, the discussion that we've heard, whether it's in the air context or in water quality trading, where you're capping the total loadings and then you're creating allowances between those loadings, and you're allowing folks to find the most cost-effective solutions to get to that point. So those markets have different outlooks and different approaches. So the offset world may look more real estate oriented, like a real estate market, while the cap and trade may look more like a commodity-based approach. And so those markets look very, very different. And sometimes you may have a blend of both. For example, in the Chesapeake Bay, if we have a cap on loadings of nitrogen and phosphorus and sediment, you may have a trading within that cap, but you may also say any new growth has to offset that growth to ensure that they can come in. So you may have a combination of these market approaches. Then I put government incentives and taxation as I view that as a market incentive-based approach. And then I get to Jim's PES concept, where I view that as it's either public or private payments done either typically in a voluntary, non-regulatory construct. So let's take an outlook quickly on some of the things that Jim mentioned. The first category, and if you can read it, is the regulatory-driven ecosystem offset world. And these numbers are a little bit old, but I just wanted to give you a framework. I think they even predate some of Jim's numbers. Forest Trends was very involved. You can see some of the resources there. But the wetland stream mitigation worlds, and this is internationally as well, is about 1.8 to 2.9 billion dollars a year. And that is, again, driven by principally the Clean Water Act, driving the concept of no net loss and mitigation. We think there's an opportunity to grow it slightly to 5 billion by 2050. And I think there's a couple themes in that market that we should be aware of. One of which is we had new law that drove the 2008 federal mitigation that basically requires and sets rules for how you mitigate. And one of the things is it created equivalent standards and created a preference for a market approach to providing mitigation. Mitigation banks is what they created a preference for. And so that's going to change how the market, the pie may not change, but how that pie is delivered may be done in more in a market way. The second thing is Clean Water Act affects both wetlands and it affects streams. Right now, we only have 13 states with protocol for mitigation in the U.S. So we've got 37 states where there are plenty of opportunities to begin looking at stream mitigation rules. And each state's going to have their own dynamic. If you're in the arid west versus the prolific rainy east, it's going to be a different looking approach. The final thing that may change this market is how you define waters in the United States or the jurisdictional impacts. And again, these markets are defined basically, they're only triggering offsets if you impact that resource. And so if waters in the United States is more broadly defined, that means there may be more impacts and more of a market opportunity. Briefly, there's about 2,183 mitigation banks that have been approved. That includes both the Clean Water Act and the conservation banking, and I'll get into conservation banking. This chart just shows you the number of banks created annually. You can see the bars get higher after 2008. And that regulatory uniformity has created the opportunity for private capital investment. There's a certainty that we know that to the extent we make those investments in these mitigation projects in advance, then we will be at least given certainty under that regulation. That's even during the economic downturn. So back to the other slide, regulatory-driven species offsets. That's 200 million, a lot less. And we think there's an opportunity to go up to $1 billion by 2050. And the issue is the rules aren't as clear. There's not this no net loss driver. You have diffuse set of resources. You've got different types of species. You have no uniform answer to the solution. And you have a resource agency that's been very confused about how to deliver it. And that has created a lot of uncertainty in the marketplace. There is going to be some new mitigation rules coming out, or guidance, this year. We already have mitigation guidance for the sage grouse, for example, on BLM land. U.S. Fish and Wildlife is coming out by the end of this year with some mitigation policy that might define principles that might create the certainty and consistency that we need in order to deliver this. Briefly, there are 163 conservation banks, so you can see a lot less. And they're primarily in California, and you can see kind of how many have been created on an annual basis in that situation. Going back to our chart, water quality trading is the next dynamic. And that is a scenario where I gave you the example of the Chesapeake Bay capping TMDLs, total maximum daily loads, that basically sets a framework for a market. Right now it's only at about $30 to $50 million, and this is a market that's clearly has the opportunity to grow to beyond $1 billion. And the issue has been there's been a set of rules to promote trading, but there's no regulatory driver to require trading. And the regulatory driver to require trading is that cap. And to the extent that cap is not enforced into the permit level, you ultimately do not get the market to take shape. And that has kind of been where we are, but there are plenty of places now that's beginning to take shape. The other thing is this has been state-driven. So a lot of the states are enacting their own market approach because the EPA has delegated the authority to the states. Natural resource damage claims is the next section, and I raised this. Right now, we have $7 billion coming from the BP oil spill, and that's going to be allocated to the states. And clearly, NERDA claims have been going on for a long time. What this slide is suggesting is there's a different way of delivering the NERDA benefits. Can we do a NERDA bank? Can we have private sector do performance contracting to deliver this? And this is one of the themes that we're seeing is oftentimes a lot of the dollars that we see are basically done on a practice base. There's not performance based. If you start putting accountability into the approach, you might create a market opportunity. Carbon sequestration through forestry, Jim mentioned that briefly. It's been understated. We only have one regulatory driver in the U.S. in California. I focused on forestry. There's other elements there, and obviously this is primarily in a voluntary construct. And then Jim talked about the government private conservation payments for biodiversity. That's $4 billion at current, and that includes things like the Farm Bill, and then also international payments. And then in terms of China, as it relates to the bottom chart, we're saying water-related ecosystem services. Jim mentioned the updated figure is $13 billion, but China is the lion's share of that. So in closing, I just want to say, market is not the end-all. But it does, it works where you have a strong regulatory system that allows consistency. And in addition, one of the things in terms of all the dollars we spend on these ecological services is we should be focused on performance-based approaches. And the more we do that, that creates market opportunities as well, which is a different tool. So I'll turn it over to Lydia, and thank you.
Thank you for the chance to be here, and forgive the Australian accent. I want to talk about something which I think is really appropriate to talk about here in this building. You're all in the business school. You talk to people in business, they talk about uncertainty, risk, investment, returns. But business is a risky game. Yet when I often go into environmental areas, people sort of say, oh, we can't expose business to risk. But that's how you make money. So what's missing from the discussion? And it's really about how you build environmental management systems that create opportunity and manage risk and uncertainty in a really clever way. What we're really talking about in business is how you share the cake. You look in the corporate world, it's full of shares and share companies and those sorts of things. So why don't we grow the cake and make the cake get bigger, which is what we've just heard about. And you can really make cakes get big if you think through and design market systems really well. And in Australia, in water, we've been doing that, and in the last few months I've been over in the United States with a team of people from Duke and elsewhere writing a blueprint for water reform in the Western States. And the good news, which I'll come back to, is I now have a group of people in Nevada who have gone back to their governor and said, we want to throw out our water rights system because it's old and decrepit and it doesn't work. We want one that's going to create value and opportunity and a future for us. The government has said, if you want to do it, we won't stand in the way, understandably. The ideas that really create value are about designing systems that are robust, that last. And you go to the dictionary of jargon and say what's robust. It's really about systems which have an ability to recover when things suddenly change and go wrong. And in water and water management, when you get things like a drought, suddenly everybody panics. What do? California's in a state of panic at the moment. It shouldn't be. A smart country, a smart nation, a smart state would have planned for drought. It's pretty obvious it's going to come along. And you'd build a system that would manage it well. And you'd make sure it was bulletproof and it would be elegant and simple to understand. It wouldn't break when things go wrong. And robust systems do that. They really do endure. And one of the best ones is the way America's created its wealth, by establishing companies and using shares to establish property rights. There's a lot of theory around how you might do this. I don't want to go into it now as the time's short, but there's good theoretical concepts about how you design things that work. I'm always fascinated that Tinbergen principle, the idea of having as many instruments as you have objectives, was given to Jan Tinbergen. And Jan Tinbergen was the man who got the first Nobel Prize in economics. Yet in virtually every economics textbook I look in today, his name's not mentioned. Why would you throw out some really good ideas? When we put robust water right arrangements in Australia in place and went to defining water rights as shares, getting things so we had proper allocations made, the internal rate of return for the first few years sat over 20%, and over the next decade was 15%, around about on average. The red line there is the return from owning shares in Australia, just normal corporate shares. So water management suddenly became profitable, and Australia went from being a boring average water management country to being the world leader in water management, because we got the foundations right. And the vision that I've been talking about in the West is perhaps America could do the same thing. And there's a huge business opportunity. And the reason why the people in Nevada I've been talking to is sitting up straight and said that if you do this, the value of your water rights might double in 5 years and then double again. And do you want to go on talking about actually missing out on an opportunity to be 4 times as wealthy as you are now? And they sit up and take notice because it makes sense. So what's the problem with the water rights systems you have at the moment in the West? And they're built around a prior appropriation system where everybody has an entitlement to a volume, a date when it was issued. Some of them go back over 150 years. Some of them are quite recent. And there's an obligation to use the water to make sure it goes to a beneficial use. Strangely, you're not allowed to save water because that's not to the benefit of America, which is a bit puzzling, particularly in droughts. But anyway, that's what the rules are. And there's a commissioner whose job it is to decide who's in priority to use the language and who gets zero water. Very good system. It's rationing. If there's a shortage, you work out who doesn't get water and who does. And it's sort of a bit like, a bit like this. In wet years, almost everybody gets a glass of water. In theory, in dry years, only a few people get water. It's a good rationing system. In theory, you could trade it. The problem is that the commissioners haven't got the courage to go out and tell people who hasn't got water. And so all the groundwater systems particularly are getting depleted. And whenever anything happens, people rush off to the courts. The problem is the courts take 2, 3, sometimes as much as 18 years to find out what the rules are. The problem is it stops raining in about a month and the shortage is there in that month. You don't have a system that works. What we've said is let's take the best ideas that are around in the world and apply them all in the West. The first one is the water resource plans are not what the current California legislation says, which are loose plans that have to be written somehow about what you're going to do. You actually write them as statutory documents which are approved by the legislature, and that's what we do in Australia. And you put in there all the exchange rates and all the rules, and then there's nothing you can go to the courts and argue about. Because if you do a water trade and the exchange rate is 0.8 and the plan says it's 0.8 and it's been approved by the legislature, provided you do this trade at 0.8, there's nothing to argue about in court. Very simple. So why don't you do it? It's not hard. If you want to have good governance, you go to the corporate world and you don't have committees of 15, 20 people, lots of stakeholder consultation. You get a small board, 5, 6 people. In Nevada where I'm working, they've said they only want 5 people to run their water boards that work out how much water is to be allocated. They want it to be expertise based, and they want no water right holders on it, because they recognise and understand that the people who make the rules would have an insider trading advantage. So they want people to go behind the veil and make a really good decision really quickly so they can get on with making money from the scarce water resources available. We've known that this is what you have to do in business for about 150 years. Why hasn't America worked out you do it for water? It makes sense and it creates value. You unbundle your water rights system, as you do in business. Rather than having every water right defined with a specific date differently, you just have shares. That cake has to be cut up, and we have a simple rule. If somebody wants a larger share of the system, you have to find someone who's going to take a smaller share, and you buy shares from them. It's simple. Why don't you do it in water? If all shares are the same, then when you do a trade, there's nothing to argue about in court. There are no third-party considerations because a share is a share. Moving to a water rights system like that just creates opportunities. If you allocate water, those glasses of water or buckets of water, as volumes that are fully tradable, it works. Now, how would you do that in the real world? Why wouldn't you go to a bank and set up water accounts that look exactly like bank accounts? When water's allocated, why don't you give people a credit? And why don't, as they use it, why don't you deduct it off the account? And so there's always a balance. They have credits and debits. And guess what? If you're running a whole river system, you can add up all of everybody's bank account or water account, you can see how much water's left. And if you want to do a trade, you do exactly the same thing as you do with your money. You log on to your water account and trade it from your account to somebody else's account. It's not rocket science. It's been done all over the world. It's not hard. Why don't you do it in water? This just seems to me to be pretty obvious. When you do these sorts of things, systems start working. And then rather than requiring water to be used, you have a use approval, a beneficial use approval. It says if you use water, you've got to use it in ways that have meters, don't cause pollution, all the other things, but you use a separate instrument to do that. These are pretty basic things, but they're not done almost anywhere in the world except in Australia. And when we moved to a system like this, suddenly people invested. Communities that had been poor, backward, run down, became prosperous again. People retired with grace because the assets that they had, which used to be worth $100,000, suddenly became worth $1 million. And these people in their 60s quite liked the idea that they could retire, and they were all the old inefficient water users, and the new water users came in with the new technology, and things happened. And the last thing you do is something which I'm always puzzled by. In America, you often have to have, even for land, title insurance. Because the title you have to land might not be a real title. The state of the art in the world is to have a government guaranteed register. And the rule is simple. If you want to own something, it must be in the government register, recorded on it. And if you want to change ownership, you contract to change the register. You make those items on the register, the shares, mortgageable. And then the banks really love it because they can mortgage something for $100. It's really obvious. Everybody knows who owns what. And trading becomes really easy. Once again, if you do that, then you create a lot more value. As I said, you set up bank-like water accounts and make trading low cost and easy. This is all obvious. It was worked out about 150 years ago. In fact, some of it was worked out, the accounting rules were worked out in the 13th century. It's just taken a long time to get it into water. And in the last part of the blueprint that we've been writing and developing, and which we're now seeing start to roll out in Nevada, we've said, why don't you try this system for 5 years? And if you don't like it, we'll let you go back to your old prior appropriation system with no guarantee as to whether or not you really got a right. Anytime you want to do a trade, you have to pay about $100,000 actually to lawyers to work out whether or not you're going to be allowed to do it. Nothing gets enforced, and you'll go broke again. And it's really interesting when you sit down and talk about creating value and designing tradable property rights systems really designed to deal with scarcity, that people take up and sit up and take notice and say this is a really interesting opportunity. I think what needs to happen in terms of the exciting developments we're seeing and all the different types of ways of approaching and creating opportunity is to spend a lot more time working on designing things so that they create value and opportunity for people while you solve environmental problems. And we build systems that openly deal with uncertainty. And I'm really excited to be here and to be working with actually people in the institute here who've been supporting the work we're doing, and all the foundations are in behind it. Thank you very much.
I want to thank our panel very much for their remarks so far. But I'd love to get the audience involved right away. So if folks have questions for the panel, please state who you are. And then if the question's directed to someone, please let us know which panelist the question's directed to.
My name is Eric. I'm a dual Masters of Forestry and MBA student here at Duke. My question is to George. You mentioned at the end of the presentation performance-based approaches. I was wondering if you could elaborate on that.
Great question, and thank you for the follow-up on that. In a lot of payment structures, there tend to be practice-based. So, for example, in the Farm Bill, if you're going to do a wetland reserve program, you're going to put in a wetland, but there aren't any performance standards that we're trying to achieve. You're focusing on the practice. You basically put it in. You may monitor for that, is that practice in or not? But we're not looking at it from the perspective of what's our goal. Is it a water quality dynamic? Is it habitat? Or is it a flood storage? And if it's a water quality situation, what kind of parameters and performance standards do we have associated with that? And then build that into that structure, and then hold the folks that are taking that money accountable to ensure that they design and achieve those objectives.
Just to build on this, it's sometimes described as an input-output choice. So you're going to basically, and there's a big debate about this. In practice, almost all the PES programs I'm familiar with are input, and not performance programs. Part of that is risk. The landowners don't want to take the risk that there's going to be a drought or fire or something else. They basically say, look, you pay us to put in the riparian fencing, to remove invasive species, and if you design it well enough, we follow your guidelines, it should work. And if it doesn't work, that's your problem, not mine.
And that's exactly the component. That component of risk is where business then comes into play. And so, as we talked about earlier, in terms of that's a perfect role for a market candidate to then participate.
So you structure payments over the life of their meeting with those commitments.
You structure payments. You would potentially financially assure it, ensure that it's in place. You will have performance standards built in your contract. You'd have monitoring tied to those performance standards. To make sure that we're achieving the objectives that we're spending the money for.
One of the things we've tried in Australia, which I'm really excited by and impressed by, is the idea of having a community payment. So you set an outcome that you're really trying to achieve, and there's a payment to all the people involved in the scheme if the outcome is achieved. And it's really interesting to then see how the people who are in there start thinking about how to improve it, because they want the whole system to work. And you get even more people involved because of respect for it. When you've got individual contracts, then everybody, if they can, will try and cheat. But if there's a separate audit, and if everybody gets a tick, then everybody gets an extra payment. It's a very interesting concept.
A couple of interesting questions maybe for each of them, Lydia, around the same theme. And I think Jim maybe ought to comment on the applicability of Mike's concept in California, let's say, where there is a very strong public trust document which would not allow the complete privatization of water as you propose. Do you see that working in California, Jim?
Yes, so it's a few things. So the public trust document essentially is this idea that the government has a right that they can't give away to protect. In California, it's actually protect the ecosystem health of waters and such. And Mono Lake was a big case discussing that. I'm not sure that Mike is talking about the privatization. of the water. And one of the things that's interesting about this is it's worked out in Murray-Darling, which is I think where it was applied in Australia, is it actually guarantees in-stream flows because some of the water is taken off the top before any allocations take place, which would be a way to address that. The question that follows on from that, though, about California that I wanted to sort of follow up with Mike is that this is all about transitions, right? I mean, I was chuckling as you were saying, it's obvious, you morons. Why don't you do this? And the reason we don't do it is because we're not starting from scratch, right? So if we were starting from scratch, we would. The issue is the transition, right? And so I guess what I'm curious about is how you persuade the government, the rights holders, the senior rights holders, the junior rights holders, because they've all got to go. In Australia, as I understand it, you obviously know much more about this than I do, there was a big buyout, and the government directed a lot of money toward farmers. That may not be accurate, but that was my understanding of how the transition took place.
There are lots of parts to the transition. First of all, it works very well with a public doctrine system behind it. In fact, Australia has that very strongly entrenched. And in fact, the statutory planning process works out how much water is going to be available, how much has to be set aside for base flows, for conveyance, and for all of that. And this is why you have a share, because a share is really a share of what's left after all of that. So the process is, first of all, is to work out how much has to be kept aside for the public good, and then the rest is a sharing system, which is much like the current property rights systems you have, but converting it into shares and a whole pile of the detail makes this a much more powerful process in terms of encouraging trade. In Australia, the conversion from the old water rights system to the one we now have was very easy. It was non-controversial because of all of the things I'm talking about. What was controversial was the decision in the actually River Murray system to stop the overuse of the River Murray and to restore health back to it. And that was done by doing something which is a world first, of putting a lot of money into buying water rights back. And that's had a double benefit, which has been really interesting, because the government bought the asset back. They went in and bought water shares. And when they did that, they then had an asset, and the government didn't want to write off those assets. So it kept them all. It said, what do we do? And we've now put them all into an environment trust. And to our absolute amazement, we've discovered we can get as much, in some areas, 2 or 3 times the environmental benefit from the same amount of water, because we now have a lot of environmental water managers who have water entitlements just like irrigators, and they have to make decisions about when to let water flow out of dams and where to put it. And it's fascinating to sit down and see a whole change in the people responsible for environmental water management. Our old environmental water managers were experts in complaining to the papers, writing reports about what was going wrong, the fact that the Australian water environment was getting worse and getting worse and getting worse, getting more polluted. Those skills are no longer needed. What are now needed is skills to work out where and how you put your water, when's the right time to release it, how to optimise and benefit. And it's been a fascinating transformation that's came out of really giving the environment a guaranteed equal share in the system. So we can no longer have a legal structure whereby actually environmental conditions can be eroded. And the allocation rules, when the environment is a shareholder, just like everybody else, if you're going to allocate water to one water account, you have to allocate some to the environment. That's the rule. And the financial credibility which underpins all the irrigation industry, now all these rights to mortgages, would collapse if water wasn't allocated to the environment. So we actually built a robust structure.
This is a question for George, I guess, maybe, and Jim as well. One of the fears that I have with conservation banking is if we don't get wetlands right, we're not quite sure what we lose except for acreage or something, and I'm a little bit worried with the conservation banking and endangered species that if we don't get something, since we're trading in habitat, if we don't get it right, we end up losing the species. And I'm just kind of curious if how you've been thinking about that as this brave new world of species banking is starting to take off, and what conversations you guys are having internally about it as well.
Well, I think you pointed to the wetland stream world and the banking dynamics there. And I would say we started in acreage and linear feet. Acreage and wetlands, linear feet and stream. And those aren't very good surrogates. And then, but what that did was to drive science and the thinking towards new functional approaches. So the market has actually driven more new analytics on functional approaches than the regulatory system ever had driven. And so it's not a perfect scenario, but it's a scenario where there's a feedback loop, and that market can then evolve over time. So applied to conservation banking, your point's well taken. One of the issues is, okay, if we require performance for species, does that mean we're going to require that we're going to guarantee a breeding pair of red-located woodpecker? We're not in a position to play God. I don't think any commercial enterprise would sign up for that. So we're using habitat right now as the proxy. But perhaps there's an opportunity to enhance habitat that's been lost, for example, longleaf pine, and then ultimately be proximate to regions where the species exist. So it's an evolution, Martin. There's no perfect answer, but I would say to you that what we've seen in the wetland stream world is that dynamic has created a feedback loop that has actually progressed the functional analysis more so than had been done historically. Because when we started, the way you defined a wetland was, we used to say, it's where the lawyers stop walking. When the shoes get wet, that's where the wetland begins. And that was basically it. You did a half-day jurisdictional determination, and you said that's a wetland. Now we're into this functional, physical, chemical, biological analysis, and we're trying to match debits and credits on that, which wouldn't have been done, but in my view, but for the market.
I'd push back a little bit on this. I mean, it's very important to realize for this types of mitigation market, it's not your typical market. So if I'm selling George, I don't know, this glass or something, he cares about the quality, right? If we're doing wetlands mitigation credits, and I'm the developer, and he's, I need the credits in order to put in a Walmart or whatever. I guess Walmart's holy today. And he's the banker. He's basically restoring wetlands. Actually, neither of us care about the quality of the wetland. What I care about is getting the permit so I can develop. What he cares about is getting his wetland essentially ticked off so he can release the credits. The only party that cares about quality in this transaction is the government. And in fact, and George knows as well, and it's his line about the lawyer, for the first decade or so with wetlands mitigation banking, the Army Corps of Engineers was largely asleep at the switch. And you got this cosmetic landscaping. And so, again, markets in themselves have a lot of potential, but for mitigation market, you'd better have a regulator who is on top of it, because if not, the dynamics of the market are going to lead to what's called Gresham's Law, which is basically the lousy currency drives out the good one. And so the government is central in this type of market. It's not basically you just push a button and then watch it go.
But it's interesting, though, to push back on your comment, is the commercial enterprises that are invested in the industry are actually promoting higher standards and want to see transparency, want to see better functional analysis, because what happens is they don't want that race to the bottom. So I don't know about Gresham and his law, but it was, and it's funny because the National Mitigation Banking Association was the one that actually adopted law that drove the new federal mitigation rule. It was not the EPA or the Corps. It was our association that said, you know what? There are very low standards. There's been a race to the bottom. There's no consistency. We want to create a consistent universe that's high standard, that's transparent. So we actually tried 4 times to pass the law. Didn't get passed. The NGOs are against it. Everybody was against it. Corps didn't like it. EPA didn't like it. And finally, some Senate staffer said, you know what? This deals with the Army Corps of Engineers. There's this Iraqi appropriation bill. Can we sneak that in there? So we've always said that we're thanking Osama bin Laden for our federal mitigation rule. But basically, that's driving, that got in place to drive the regulation. And now the Corps and the EPA are embracing it. But I would say that's a good example of industry saying we want high standards because we want to get those bad actors out of the equation.
And let me just come in here because this is important in terms of design. It's better to be approximately right than comprehensively wrong. And this is really important. And if you're building a system and building it well, having simple rules that get approximately right, which are conservative, means the transaction costs are low. It's very easy to employ consultants and everything and spend a fortune trying to work out what you're saving in each area. These systems work because they're units of exchange, and if you're concerned about losing habitat, then why don't say, look, you've got to put 2 hectares in for every one you take out. Approximately rule, and if someone can work out something that's a little bit of refinement on that, then do it. You're right, the government has to be in there enforcing the rules and making sure that's exchanged, but we've found in water management and lots of other things I've been involved in, scientists and everybody want to design things that are very, very expensive to run. These systems work because they're simple and you can explain them to your grandmother. And if you can't explain them to your grandmother, they don't work.
Like, that is exactly the rule in North Carolina. So North Carolina, for their wetland, it's a 2-to-1 ratio. And people have complained about that. They're moving towards a functional assessment, and Martin knows well of the movement there. And that has been very successful, to your point. Meanwhile, you go to a state like West Virginia that says physical, chemical, and biological functional analysis. There are 13 different analytics. We don't know enough about the benthic macroinvertebrates. If we do X, Y, Z in a stream, then we're going to see this uplift. So we never take credit for that. And then we throw out some of the physical benefits, because in water quality, I can't control all my upgradient areas, so I won't take that. So I'm only then looking at my physical component of my crediting under that, and I'm going through many days of calculations when I could have done a 2-to-1. So to your point, it's been much more successful. I think North Carolina is a great example.
Just a quick robustness question from Australia, if you would. We have future projections looking at stream flow absences in the near term. How do you build that into a system that you can guarantee stream flow with future projections for climate change, especially in a dry island nation like yours?
Firstly, you can't guarantee stream flow because you can't guarantee it's going to rain. And what you need to do is actually decide how much gets taken off and in what conditions you go to zero. The important thing about sharing systems is even if the allocations are zero, you still have a share. You could buy shares in water in Australia in the 2006 drought, and they were still worth about $2,000 a megalitre when allocations were zero, because the professional assessment was going to rain again in the future. That's a risk. So you design the system to do that. In the most sophisticated system that deals with climate change, the management plans have a ceiling on the maximum amount of water that can be taken each year, and that maximum is a function of essentially the moving average of inflows into the system. So if the system gets drier, the actually maximum amount of water can ever be allocated comes down. So from day one, if we start getting drier, everybody's told the system's getting drier. It's really interesting, the value of the shares goes up because water's becoming scarcer. And so once you build in these things, which are robust, and you say, look, climate change might happen, it might get wetter, it might be dry, why don't we build a formula in that automatically does it? Then you don't have to have the formal reviews. Everybody recognises the risk, and you can bank on it, and you can speculate on it if you want to.
Right, one last question.
Back to conservation banking, I'm curious, George, and maybe Jim, you can speak to this. The kind of propensity for private landowners to skirt the Endangered Species Act, such as they've done with the sage grouse, through private land provisions that are largely applauded by environmentalists. How do you see that affecting conservation banking?
It's been a pretty significant raging debate, and this is the question about permanency versus term. And the idea is if you can do management plans on a landscape scale for species like lesser prairie chicken or sage grouse, which are over broad landscapes, there's some in the environmental community that are promoting this concept of at least getting term approaches with landowners to manage for the species for that period of time. While those of us who have lived in the conservation banking world, we basically can't get a credit unless we have a permanent conservation easement. And there's a question about, okay, if the term's 5-10 years and that comes up and that landowner wants to develop, what have we done with respect to that species? There's no easy answer, but I do think there are differences in the species and the conservation strategy has to be defined based on that approach. So if our goal is greater landscape scale approaches to manage for that species now, because of the nature of that species, perhaps there is a lesser opportunity to say something less than permanent could be suitable. Although I think our preference should be permanent, and I think there should be incentives built into the system to promote permanency as much as we can. But the problem is most landowners have a hard time signing up, and secondly, it's expensive. So our buyers, the oil and gas guys, are basically squawking at that. And I think, so we had an issue with a lesser prairie chicken that was driven in Texas where the term was allowed, but it was primarily driven by the oil and gas community to promote a lesser standard that the state adopted, and that's not the right way to go. So science should drive it. This conservation strategy is going to look different. Permanent isn't always the answer, but it should be the favored son.
Yeah, just briefly, I think the problem, and I'm more skeptical than George is about the size of species backing, because I think it's going to be ad hoc almost every time. And I think I'm not optimistic you're going to get sort of uniform rules, which is what would allow much more market development.
Great. Well, I would like to thank our panel for joining us today.